Good day, fellow investors. My name is Sven Krlin, and today I'll discuss an example of market irrationality. There are two theories. One is that markets are efficient and every information is always priced in the price of a stock. And there is the other theory that markets are inefficient, but people think are efficient, and we, value investors, can take advantage of it. A recent development has seen Kroger's stock price drop from above 30 to around 20, now I think it's around 22. What happened? First, Kroger announced no growth in earnings. They lowered their guidance a little bit. Their guidance was earnings of 2.2 per share in 2017. They lowered it to 2.05. So they lowered it by 15-20 cents, their earnings. They are still $2. The stock price fell $8. First irrationality. 20 cents lower earnings, stock price falls $8. Then the story about Amazon entering the playing field, and the stock dropped even further. However, we now have a stable grocer, Kroger, with a price-earnings ratio of 11, which is very low when compared to the S&P 500 that has a price-earnings ratio of 25.7. Now, just to show you how the market is irrational, I will compare current and future Kroger's earnings and what an investor in Kroger and in the S&P 500 can expect. If we invest $100,000 in the S&P 500 at current valuations, we can expect yearly earnings of $4,000. If we invest the same $100,000 in Kroger, we can expect yearly earnings of $9,000. The difference is clear. Kroger has a lower valuation because it didn't grow earnings in the last 3 years, as earnings are stable around $2 per share. Now, as the example of market irrationality, we will assume that Kroger doesn't grow earnings for the next 30 years and S&P 500 earnings grow at 5% per year. So we have S&P, let's say it's a growth company at a price-earnings ratio of 25, you are a growth asset, and Kroger, which is a cash cow, they increased their dividend and announced a 1 billion stock buyback, that's about 5%, plus 2.5% from the dividend, that's 7.5% is the yield if you buy Kroger now, but that's a different story. So I have compared the cumulative earnings for both the S&P 500 and Kroger for the next 30 years. Kroger, no growth, S&P 500, every year we grow 5%. And this is the result. If an investor invests now in the S&P 500, and my growth assumption is correct, it would take him 31 years to achieve the same earnings as what an investor in Kroger would achieve, even if Kroger's earnings don't grow at all. So this is a clear example of a complete misperception about value, earnings, and earnings growth. 30 years, it's simply crazy. Now, I don't know what will happen to Kroger. I know it's a good company. For me, it has a little bit too much debt, but if you want to invest, I'm sure you will analyze it deeply. My point is that there are bargains out there and the market is totally irrational. Kroger might be one of those bargains, might not. I'll put a video tomorrow about a stock that is perhaps also a bargain. So by in-depth analysis, I'm sure you can find one. However, the S&P 500 is completely overvalued because one stock like Kroger will outperform the S&P 500 by many times over the next 10-20 years, just because its valuation is much lower. Please leave your comments below what you think about Kroger, about the S&P 500. Let's build a community here. let's increase our general knowledge in order to lower our risks and increase our returns. Subscribe for more content, and thank you very much for watching. See you in the next video.